Are you looking to tap into India's top private banks with a single investment? With the private banking sector booming in India, is it now the right time to invest in the UTI Nifty Private Bank Index Fund? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decisions to reach your financial goals in a more faster and smarter way. Now, before analyzing whether investing in this NFO will be a worthy investment or not, let us first understand a few basic details about this NFO. So, as an NFO, it opens on 2nd September 2024 and closes on 16 September 2024. And some of the key features of this NFO are: it is an open-ended fund type, belongs to the category of sectoral banking, and it has Nifty Private Bank TRI as its benchmark index, and it has no exit load, and there is no entry load as well. And the minimum amount you need to start investing in this fund is just 5,000 rupees. And the fund managers for this NFO are Mr. Sharwan Kumar Goyal and Mr. Ayush Jain. And according to the riskometer, the risk involved in this fund is very high. And if you look at the investment objective, the primary investment objective of this fund is to provide returns to the investors before expenses, which closely correspond to the total returns of the securities as represented by the underlying index, which can be subject to tracking error as this is an index fund. So speaking about the index, now let's take a look at the index this NFO is representing, which is the Nifty Private Bank Index. So the Nifty Private Bank Index is designed to reflect the performance of the banks from the private sector. So this index can be used for a variety of purposes such as benchmarking fund portfolios, launching of index funds, ETFs, and other structured products. Now let's take a look at the top 10 holdings in this index. So the top 10 companies are the ICICI Bank Limited, HDFC Bank Limited, Kotak Mahindra Bank Limited, IndusInd Bank Limited, Axis Bank Limited, Federal Bank Limited, IDFC First Bank Limited, Bandhan Bank Limited, RBL Bank Limited, and City Union Bank Limited. And the highest weightage is given to the ICICI Bank Limited, which is a top first position by a weightage of 26.42%, while the top 10th position is given to the City Union Bank Limited with a weightage of 1.63%. Now, if you take a look at the index returns as on 30th August 2024, you can see that in 1 year it has produced a return of 12.96%, and in 5 years it has produced a return of 11.46%, and since inception it has given a return of 19.15%. And if you take a look at the long term graph also, in long term it has performed better compared to the short term period. So from the index returns and the graph, we can, on the data, this is what we can conclude about this index. So now we have understood what is UTI Nifty Private Bank Index Fund and what is the index it represents. So we have understood the basic details about this fund. Now let's take a look at the pros and cons of investing in this fund for us to analyze whether investing in this will be a worthy investment or not. Let's start with the pros first. So one of the major advantage of investing in this is the exposure to leading private banks. So this fund invests in top tier private banks in India, which are known for their strong balance sheet, efficient management, and growth potential. These banks have historically outperformed their public counterparts in terms of profitability and asset quality. And next point is the focused investment strategy. So with a focus on the private banking sector, this fund allows you to capitalize on a specific segment of the market that has shown resilience and consistent growth. And another advantage is the low expense ratio. Since this is a passively managed index fund, the expense ratio is relatively low compared to actively managed fund. This means more of your money stays invested, potentially leading to better long-term returns. Lastly, another one of the major advantages is the liquidity. So the banking sector in India is one of the most liquid sectors, and this fund benefits from that. You can easily enter or exit your position without worrying about any kind of liquidity issues. So these are some of the advantages. Now let's take a look at the disadvantage. It's equally important to understand the disadvantages as well, because it reveals the potential risk you might be undertaking while while choosing to invest in this fund. So now take a look at the major drawbacks of this fund. One is the sector concentration risk. Because this fund is concentrated solely in private banks, it's vulnerable to sector specific risk. Any negative development in the banking sector like regulatory changes or economic downturns can significantly impact the fund's performance. And another drawback is the volatility. Private banks tend to be more volatile than other sectors, especially during market corrections or financial crisis. This could mean larger swings in your investment value and limited diversification. If you're looking for a well diversified portfolio, this fund might not be the best choice since it focuses only on private banks. You need to complement it with other investments to achieve a balanced investment portfolio. And finally, the interest rate sensitivity. The performance of private banks is closely tied to interest rates. Rising rates can squeeze profit margins for banks, which could negatively affect the fund's returns. And another important point to consider is that this is a index fund, which means that it will only try to replicate the performance of the index and it will only try to match the index. So you cannot change the fund allocation dynamically based on the market conditions, even for market corrections. So that's also another drawback, which means that even in the best, it will only try to replicate the index performance and you will not be able to get a return that will beat the index itself. So if you're expecting investment like that, this might not be the suitable fund, which you need to also remember before choosing to invest in this fund. So these are some of the advantages and disadvantages of investing in the UTI Nifty private bank index fund. So finally, what is the final takeaway from our analysis? Is investing in the UTI Nifty private bank index fund really a worthy investment or not? From our analysis, what we can understand is this fund offers strong exposure to India's leading private banks, benefiting from their growth and resilience. However, its concentrated focus on the banking sector makes it more volatile and susceptible to sector-specific risk. While it provides low cost and high liquidity, it lacks diversification and is sensitive to interest rate changes. So you can consider this fund if you're confident in the private banking sector and can tolerate the associated risk. But however, it's essential to align this fund with your financial goals, your risk tolerance, and what kind of time horizon you have for your investment goals and your financial goals. You need to consider all these factors, and it's completely up to you to decide whether investing in this will be suitable for your investment portfolio or not. But from our personal opinion is that if you're choosing to invest in it and you're an ultra conservative investor who does not want to invest in actively managed funds and you do not want to take any kind of risk, then this might be a suitable investment option for you. But even then, there are other similar index funds out in the market that has a lower expense ratio and a lower tracking error compared to this fund. So instead of investing in this NFO, you can definitely choose better index funds like that, which has a lower tracking error and lower expense ratio. And if you're willing to take at least a little bit of risk, or just if you want to invest in an actively managed fund, then you can definitely choose to invest in an actively managed fund as well, because it has more potential to deliver higher returns compared to an index fund like this. And also, especially if you're an investor who's expecting dynamic fund management and looking for investments that can beat the market itself, then you should definitely avoid investing in this fund and choose to invest in an actively managed fund, because an index fund like this does not have dynamic fund management or investments that can beat the market. The best it can do is it will try to replicate the performance of the index and try to represent and provide returns that can closely represent the total securities of the index it is representing. So if you're still struggling, or if you're still doubting what investment will be suitable for your investment portfolio, or whether this investment will be suitable for your investment portfolio, you can definitely consult with your certified financial planner, who as a professional would be able to help you manage your investment portfolio and your financial planning and your investment journey and make it more simplified and easy for you, which can be very helpful for you in your financial future. So you can definitely consider investing through a professional as well.
And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.